Hi everyone. In this video, I'm going to dive into Ray Dalio's all-weather portfolio, or what he calls his holy grail of investing, and we're going to explore his unique investment strategies. So stay tuned. If you've never heard of Ray Dalio is the founder of Bridgewater Associates. And in my opinion, he is the smartest hedge fund investor on the planet. I mean, everybody's heard of Warren Buffett. Not too many people are familiar with Ray Dalio. Now, he has become very active lately on social media. He retired a few years ago, and he often talks about what he calls his holy grail of investing. And you'll see people in the comments that they don't understand what it is or how to do it. So I'm going to break that down in this video. And understand that this is his beta model. He has a beta model and an alpha model. Now, with the beta model, we divide this into four quadrants, right? You have your stocks, your equities, and you have corporate bonds, and you have gold and commodities in one quadrant. The other quadrant, you have commodities, gold, and inflation protected bonds, which are often called TIPS. Then you have treasury bonds and TIPS in another quadrant, and treasury bonds and stocks in another quadrant. Now, the idea is your portfolio, you're going to want to keep 25% into each quadrant because diversification is the best way to protect your assets. Now, when the stock market changes, let's say stocks do really good, your corporate bonds do really good. So now your portfolio has an imbalance. You're going to want to rebalance that portfolio. Some people do it every 3 months. Some people do it every 6 months. Some people do it once a year. There really is no wrong answer. And the idea is nobody has a crystal ball. We can't predict the future. And trying to time the market, you're just setting yourself up for failure. So when you systematically rebalance your portfolio, you're going to buy low and sell high. That's how you move from this 35%. You're selling off some of your stocks, and you're rebuying some your gold and commodities or bonds or wherever you're low at. So if you want to be active, do it every 3 months. If you want to set it and forget it, maybe do it every 12 months. But now there's two key factors that he follows that really dictate how the market goes. So when you look at like growth, like where are we at, our GDP, the best indicator for growth is going to be the Fed interest rates. Everybody knows that when the Feds lower the interest rates, it makes it easier for people and companies to borrow money, and they put that money into circulation, and that increases your basic stocks. Your Fortune 500 companies do really well, like Tesla, Microsoft, Nike, Walmart. And the opposite is true. So when the Feds raise the interest rates, that strengthens the dollar, and then your US bonds get tougher. Now, the second thing that he keeps track of is inflation. So when inflation is high, your best hedge is going to be commodities and gold and your inflation protected bonds. And you could put REITs in there, which is real estate trusts, which is another great hedge against inflation. And the opposite is true. When inflation is down, dollar strong, so you want US bonds and stocks as well. But the thing with inflation and bonds, well, the thing with inflation is that the Feds aim to get it about 3% a year, which means if you buy a bottle of water today at $1, this time next year, it's going to cost you $1.03. And if you have money that's sitting in a savings account that's only getting 2.5% interest on it, that value of that dollar you're losing to that 3% inflation, right? So anyhow, here's what I would invest in personally. Now, do your own due diligence. Understand that this is not financial advice per se, and I'm not a financial advisor, but this is what I do. So when you look at stocks, you have what they're called, there's index funds and ETFs, which SPY and VOO are models of the S&P 500. You and I can't invest directly in the S&P 500, but there's index funds and ETFs that are modeled after the S&P 500. So rather than just buy like one share of Tesla, it's better to buy a share of, SPY, let's say, And now you have exposure to 500 companies. And your corporate bonds, LQD, GLD is good for gold, TIPX for my inflation protected bonds, TLT is a good one for you, Treasury bonds, and VNQ is a good REITs one. But as I said, do your own research. Now, like I said, this is his beta model. With his alpha strategy, now let's say we know that the feds are going to lower interest rates and that's going to stimulate the stock market. So leveraging is just another fancy word for borrowing. And that's what he does with this alpha strategy. He says, okay, well, we're here in high inflation and low growth, and we believe that the feds are going to lower the interest rates. That's going to stimulate the economy. So I want to buy more stock. So he'll borrow, let's say $1 billion, and he'll go invest in those corporate stocks or corporate bonds and stocks. And there you have it. That's his all-weather portfolio in a nutshell. Thanks for watching, and I hope you found this breakdown of Ray Dalio's all-weather portfolio insightful, and it'll help you build a more resilient investment strategy. Be sure to drop a comment below. I'd love to hear your perspectives, and if you enjoyed this video, be sure to give it a thumbs up, and I will see you in the next video. All the stars are close, all the stars